Hello, hi, welcome to Zerodha Varsity videos. I am Satya Sogdanam. In this video, we are going to understand the flaws of averages. I have with me Ravi Saraogi, a chartered financial analyst who is very interested in crunching a lot of numbers. He is going to explain this with the concept of sequence of returns risk. Hi Ravi.
Hi,
what is this tongue twister sequence of returns risks?
Yeah, so it's a simple concept and it's omnipresent.
Okay.
It basically says that two portfolios can have the same average return,
Okay.
but very different ending values.
Can you dumb it down?
Yes. Yeah. So let's take an example of a road.
Okay.
Two roads which have the same length. But it doesn't mean that because it's the same length, if you travel on those roads, you will cover the distance at the same time. How much time it takes depends on how those roads are. So one road could have a lot of curves and it'll take a lot more time. Another road could be a highway and it'll take a lot less time. So it's very similar. You can have two portfolios with the same average return, like two roads with the same length. But those portfolios, the ending value can be very, very different. Because one portfolio may have a lot of curves, it may go up and down a lot, and the other portfolio, it may be more straightforward and linear, and the average return is the same in both the portfolios, but you will see that the ending value will be very, very different.
Our audience loves numbers, so can you explain this with an example?
Yeah, sure. So Satya, we have two portfolios here, portfolio 1 and portfolio 2 with the same average return. Which one do you think is better?
Since it has average return of 12% each for portfolio 1 and 2, will there be a drastic difference? I think it's the same.
Yeah, so unfortunately not. Both these portfolios will have very, very different outcomes. So what we have done is in portfolio 1, there is a sequence in which that portfolio earns its return. And in portfolio 2, that sequence has been inversed.
Yes, I can see
so
that.
So as you can see in year 5, portfolio 1 is minus 15%, but portfolio 2 starts with minus 15% in year 1. So the sequence has been reversed, but the average return is the same.
Right.
And you can see in this table that portfolio 1 ends with 141. So it starts with 100 and it ends at 141.
After 5 years.
After 5 years. And portfolio 2 reaches only till 130.
Wow.
And that's, again, even though both of them have the same average return. So this is the sequence of return. So you have to not only look at the average return, but in what sequence was that return earned.
Makes sense. This is a key takeaway for me that, most of the investors sometimes, calculate their returns on their portfolio by just taking what is the yearly return that they have earned and then take an average.
Yes.
That shouldn't be the case. Even if two investors have similar average returns or the same average returns, their portfolio values could be, as you have shown here, could be, very different.
Absolutely, Satya. And there's a very famous story. Will you cross, a river which has average depth of 3 feet? So I can see you're more than 3 feet. So would you take that challenge?
Because you just explained me this, I think I wouldn't take it because 3 feet, as you said, it's an average, and it could be 6 feet also. But I'm just 5 feet and I don't know swimming, so I don't think I would be taking that risk.
Yeah, absolutely. So that example, talks about the risks of basing decisions just based on averages.
Is there any other key takeaway or the implication of this sequence of return risk?
Yeah. So, one thing which emerges from the sequence of return risk is that portfolios which are not very volatile actually have better outcomes. So we may tend to think that portfolios which go up and down a lot may eventually do better.
Yeah, that's what we've learned in our college and school also, that higher the risk, better the return.
Absolutely. And, you have hit the nail on the head, Satya. Throughout our college, and masters, we have been taught that the return of a stock, for example, is a function of beta. where beta is a measure of how volatile it is. So higher is the volatility, higher should be the stock return, because an investor who invests in a volatile stock should be compensated for taking that higher risk. So this is what the capital asset pricing model has been telling. But empirically, when you test this, it doesn't work. What you see is that low beta stocks actually do well and high beta stocks do worse. So this is internationally called as the low volatility paradox, where low volatile investments seem to do a lot better than high volatile investments. The exact opposite of what we have been taught.
Is there any research or is there any numbers of the historical data that we've looked at?
Yeah, so capital asset pricing model was introduced in 1950s and 1960s.
Okay.
That's when people got this idea, and it held sway for about 10 to 20 years more. But from about 1980s onwards, there were several independent studies in the US which documented that beta is not explaining stock returns at all. And high volatility stocks are not doing well. And in fact, let's look closer at home in India. You can actually test this yourself. For example, Nifty has an index called as the low volatility index. So it's called the low vol index. And it also has a high beta index. So you can look at the performance of these two indices over the last 10-15 years, and you can see that low volatility has done stupendously better, and high beta has is nowhere in the picture.
Brilliant. Is there anything else that we have to learn about this? Maybe
so in fact, it's a conundrum that because the data is so evident that low volatility products do better, why don't investors invest in these products more? If you look at generally in the market, people gravitate towards high volatile investments.
Right.
And that's because high volatile investments have the promise, at least, that it may do really, really well. Whether it does or not, data shows it does not. But when you invest in high volatile products, you have a hope that you will earn supernormal returns.
And also the short upticks give us the kick.
Yes, short upticks give it the kick, So for example, when a stock goes from 50 to 100, it's a terrific, jump that people see and that excites them.
It's a great validation on our investing
yes,
knowledge.
Yes, but those high volatile investments can equally come down. And then it's a big challenge to again get that value up.
So true. Yeah.
So it's called the lottery effect, where investors perceive their investments more like lottery rather than investments. And which is why high volatile investing still holds sway.
I understand. So, I remember you were giving this example on, holding a stock which is of 100 rupees of value. If it falls down by 50%, it goes to 50. But for that 50 to go up to 100, it has to give 100% return.
Absolutely.
To go to 100.
Absolutely. So, so the journey down is, of course, terrible because you have to take a hit in your, capital gains. But the journey up can be even more painful, because you have to travel twice the distance to get up to where you were before.
Got it.
And I think low volatile investments, work really well for investors, empirically as well. But it's behaviorally a lot more taxing to invest in low volatile products.
Understood. Is there anything on, retirement portfolios that we could link it to, the risk of this to retirement portfolios?
Yeah, so actually, Satya, the sequence of return risk is very, very pronounced in retirement, because retirements are long portfolios, and there it matters a lot in what sequence such returns, were earned. So it has a lot of significance for retirement planning.
Yeah. Because I think you always say this, retirement portfolios go very well in Excel.
Yeah. So they do very well in Excel because it's all straight lines. When we use our present value, future value formulas, there is no way to change the R, the rate of growth. You can't change that, whatever period you are putting that formula for. You have to specify a single value. Yeah,
the assumption is that it grows at the certain rate every year.
Yes, but in reality, as we know, is very different. Each month each quarter, each year is different. And that changes the game altogether.
And is there an alternative?
Yes, so there is, which is why for retirement planning, we use the concept of safe withdrawal rates.
Yeah.
So that takes into account sequence of return. It doesn't work on the basis of averages. Safe withdrawal rates are obtained based on simulations of historical returns. So they bring into them, and it's baked into them, a lot of different return assumptions. There is bear market, bull market, high inflation, low inflation. All of those things are baked into the safe withdrawal rate concept, which is why it's much more powerful to use that.
Ravi and I did a video earlier on safe withdrawal rate for retirement. You can check that video for more information. Thank you, Ravi. Thank you so much for joining us today.
Thanks, Satya. Thanks for having me here.